Here's the thing nobody tells you: when you cross $2 million in net worth, you've entered one of the hardest places to retire from in the entire financial spectrum.
Not because you don't have enough money.
But because you have just enough that every mistake is expensive and not nearly enough to ignore them. This is the awkward middle of retirement planning. The $2 to $5 million household. From the outside, it looks like the finish line: enough to retire, enough to have options, enough to breathe. But in practice, this is where the tax code hits hardest, where generic advice fails most completely, and where the gap between a good plan and a bad one is measured in hundreds of thousands of dollars. Today, we're going to break down exactly why retirement is harder at this level of wealth, where the worst trade-offs live, and how to actually optimize, not just survive, your retirement in this range. If you've crossed $2 million in net worth and retirement still feels more complicated than it should, you're not wrong. This video breaks down exactly why, with real numbers and no fluff. Let's get into it. So first, why is this range so uniquely difficult? Think about the two ends of the spectrum. Below $1 million, planning is about discipline and sustainability. You're constrained, but the problems are clear. Above $10, $20 million, you can afford inefficiency. Taxes are a nuisance. You spend around problems rather than optimize around them. But at $2 to $5 million, you live in neither world. You have meaningful retirement savings, but heavy exposure to pre-tax accounts. You're below the federal estate tax threshold, but fully exposed to income taxes, IRMA surcharges, and required minimum distributions. You have just enough flexibility to optimize, but not enough margin to be sloppy. Every decision matters, and that's exactly what makes this range the awkward middle. Now let's talk about the real enemy here, and it's not what most people think. At this net worth level, your biggest risk isn't market volatility. It's your tax bill. You likely have large traditional IRAs or 401ks that will generate taxable income whether you want it or not. Your Social Security income pushes your provisional income higher, triggering IRMA adjustments that quietly eat into your Medicare costs. Capital gains in your taxable accounts can be taxed at nearly 20% if you're not careful. And then RMDs arrive later in retirement like a bill you forgot you'd owe, forcing income spikes at the worst possible time. The ultra-wealthy have tools to absorb this: trust structures, charitable vehicles, excess capital. You don't, which means you're facing full income tax exposure with none of the shelters, and that creates constant trade-offs with no clean answers. Convert to Roth now and pay taxes today, or wait and face an RMD avalanche later. Take income now and trigger IRMA, or defer and compress the taxes into your 70s. Spend from taxable accounts early for flexibility, or preserve them for capital gains optimization. Every move solves one problem and creates another. And here's something most families in this range don't see coming: a tax trap hiding inside what looks like good news. Most families with $2 to $5 million will never owe estate taxes, and they treat that as good news. It's not entirely. When estate taxes aren't a factor, income taxes become the dominant tax, and income taxes don't stop at death. Under current rules, your heirs must distribute your pre-tax retirement accounts within 10 years. Those distributions stack on top of their own income, often pushing them into the highest marginal tax bracket of their lives. So there's no estate tax, but there can be a massive inherited income tax problem. Families in this range routinely get caught flat-footed because they assumed no estate tax meant no tax problem. In reality, it just shifts the problem and often makes it worse. So what's the fix? Most people in this range have heard about Roth conversions, and they can be powerful. But this is where it gets delicate, because done wrong, they can actually destroy value. Convert too little and your RMDs explode in your 70s, bracket creep, Medicare premium spikes, taxes compressed into years when you're spending less and have the least flexibility. Convert too much too fast and you're paying high marginal rates unnecessarily, triggering IRMA surcharges that erase much of your benefit and reducing liquidity during your most active retirement years. For $2 to $5 million households, Roth strategy isn't about converting everything. It's about threading the needle. That means intentionally filling lower tax brackets, not blindly respecting IRMA cliffs, coordinating conversions with actual spending needs and thinking about what tax bracket your heirs will be in when they inherit. This level of precision is exactly where generic advice breaks. Many advisors either skip Roth conversions entirely or do them without any real strategy, often because the client asked and the advisor didn't want to rock the boat, or worse, because conversions reduce assets under management and the advisor didn't want the revenue hit. 9 times out of 10, just having a real coordinated Roth conversion strategy for clients in this range saves 6 figures or more in lifetime taxes. That's not marketing, that's math. Which brings us to the advice problem itself and why the rules you've probably heard are actively working against you at this level. Most retirement advice falls into 2 buckets: rules of thumb or extreme case planning. Neither works here. Rules of thumb tell you things like spend your taxable assets first, delay Social Security to 70, convert as much as you can at low rates, hold a 60-40 portfolio, follow the 4% withdrawal rule. These are fine starting points. They're also wildly inefficient when applied without context. A 60-40 portfolio might be the right allocation, but which accounts should hold equities and which should hold bonds? Asset location matters enormously for after-tax returns. A 4% withdrawal rate might be appropriate, but what if smarter tax sequencing lets you achieve the same after-tax income at 3% withdrawal, allowing your portfolio to compound on a larger base? That's not a minor difference. That's legacy wealth versus running out of money. Extreme case planning is even worse. That framework is built for people with $200,000 or $20 million. You're in neither camp. Spending taxable first can inflate your future RMDs to a damaging level. Delaying Social Security without income modeling can create cash flow strain during the gap years. Aggressive Roth conversions without IRMA awareness can cost more in Medicare surcharges than they save. Static asset allocations ignore sequence of returns risk entirely. The margin for error is smaller in this range, but so is the opportunity, which means personalization matters more, not less. There's another dimension to this that's just as important, and it cuts both ways. You need growth. 30-plus year retirements, healthcare cost inflation, and purchasing power erosion are real threats that require your portfolio to keep working, but you also can't absorb significant drawdowns the way an ultra-high net worth household can. A bad sequence of returns in early retirement can cause permanent damage, and there's no excess capital to bail yourself out. You haven't made ignore the market's money, but you've made way too much to run on autopilot and hope it works out. That means risk has to be intentional and purpose-driven, calibrated to your actual income needs, not some generic return target. And there's one more layer here that almost nobody talks about: the psychological side. Households at this level often feel like they should be fine, so they hesitate to ask for help. They compare themselves upward and quietly fear running out of money, but don't want to admit it. That anxiety pushes people into one of 2 bad outcomes: over-conservatism that slowly erodes purchasing power, or over-aggressiveness chasing certainty that creates unnecessary risk. Neither extreme works. What actually works is clarity, not just projections. Knowing exactly what your plan is and why every decision is made the way it's made. Let's make all of this concrete with real numbers. Take a couple retiring with $3.2 million, total $2.1 million in pre-tax accounts, $700,000 in a taxable brokerage, $400,000 in Roth. Without coordination, RMDs push them into higher brackets by their mid-70s. Medicare premiums spike. Their heirs inherit large taxable IRAs and face the highest marginal tax rates of their own lives. Same wealth, brutal outcome. With coordinated planning, gradual Roth conversions over 8 to 10 years, ideally in the window between retirement and Social Security claiming, taxable assets used strategically, Social Security optimized for survivor protection, RMD exposure reduced, heirs receive tax-efficient assets, same starting wealth, dramatically different ending. Here's how the numbers actually work. This couple needs $10,000 a month after tax to live on. If they do nothing and let the IRAs grow untouched, by their early 80s, their R&Ds plus Social Security push them into the 32% bracket. Instead, they target the second IRMA bracket, capping modified adjusted gross income at $274,000 for the year. They take $120,000 for spending, realize $25,000 in capital gains to cover their roughly $45,000 tax bill, bringing their AGI to $145,000. That leaves $130,000 of conversion capacity, so their IRA balance drops by about $250,000, 12% of the account, with more than half going into Roth. Yes, they'll pay IRMA surcharges of $95 per person per month. But if they start this at 62 and take Social Security at 70, they have 8 years to run this strategy. By then, their pre-tax balance could be reduced to roughly $1 million. Their Roth could grow to $2.1 million, and their Social Security is maximized. After Social Security starts, they scale back to filling the 22% bracket, typically just below where IRMA kicks in, and their pre-tax balance stays roughly flat as R&Ds begin. Instead of being forced to withdraw at 32%, they stay in a 22% bracket for the rest of their lives. That 10 percentage point difference in marginal tax rates is how you unlock hundreds of thousands of dollars that stay in your pocket instead of going to the IRS. For portfolios in this range, that often represents a 10 to 15% increase in total lifetime wealth. No extra investment risk, no side income, no sacrifices, just planning. Layer in qualified charitable distributions when RMDs begin, and some or all of those RMDs come out tax-free. Eventually, the pre-tax balance can reach zero, fully converted to Roth for heirs. At that point, their taxable brokerage provides income that can also be tax-free, staying within the 0% capital gains bracket. This approach is sometimes called the pseudo-Roth, and it's one of the simplest and most underused levers in retirement planning. So what does all of this actually require? It's not exotic investments. It's not complexity for complexity's sake. The answer is simpler and harder than that. It's integrated tax planning, income modeling, risk alignment, clear decision frameworks, and ongoing coordination. The value isn't beating the market, it's avoiding expensive, avoidable mistakes. The process works in 3 steps. First, use the tax code to your advantage. Second, manage assets to grow efficiently while keeping income and capital gains controlled. Third, withdraw and convert up to specific benchmarks targeted to maximize your after-tax outcome. If your current advisor doesn't have a version of that plan built specifically for you, that's not a minor gap. It's costing you real money every year you wait. So here's the bottom line. Retirement planning is hardest in the $2 to $5 million range because you face almost every major financial risk without the luxury of ignoring any of them. Full income tax exposure, no estate tax shelter, complex interconnected trade-offs, tight optimization windows, and little margin for error. Generic advice fails here because this range lives in nuance, not in absolutes. The families who retire well in this segment aren't the ones who found the perfect answer. They're the ones who made intentional trade-offs, backed by actual planning, not guesswork. If you're in this range and retirement decisions feel harder than they should, you're not imagining it. You're just in a part of the financial landscape that most advice wasn't designed for. If this gave you a fresh perspective or sparked a new idea, give this video a thumbs up and subscribe. We break down these planning frameworks regularly, and every one of them is designed to help you keep more of your money where it belongs. As always, make smart money decisions.